You've argued that growth compounds value in a way that margin improvement can't. I thought that was a really succinct statement. There's a lot in there. Can you unpack it for me?
All right, where to begin? So on growth, we're in a market that is moving incredibly fast. Capturing more market share will give you the opportunity to do more things and to get a foothold with customers and become the de facto standard. I think that will compound and give you more benefits over time. We even see it with our own customers that may have started on one Vercel product and are now using multiple products because they had a good experience with the first product. As long as we continue to make improvements and ship new products that are delighting customers and adding value, I think there is a lot of value of having a relationship with that customer. If you optimize for margin too early, you're likely going to miss out on that growth curve. Now, I'm not saying don't have any gross margins, but find like the optimal balance between the two and don't make short-term decisions that will reduce your growth in favor of margin when you still have the potential to massively accelerate.
How do you know to keep accelerating into that? What are the signals?
Are we able to like maintain or accelerate our growth rate? Right.
Are you growing faster than you were before at a larger scale?
Correct. So that's like one obvious sign that
That'll hit you over the head.
you're doing well. Yeah. And we obviously have some like guidance metrics as well of like, do we have a healthy cash balance, which we do, relative to burn, which we do. So we do look at sort of that from more holistic basis. But I do think we're in a market that the opportunity to sort of build a very large business and AI infrastructure is happening right now. And if we don't have like the biggest bucket and we possibly can to capture this wave, someone else will.
I like how you brought the competitive element into it as well. Like someone is going to take advantage of this opportunity. It's not just about our gross margin or profit margin. It's about in the macro context, do we have the right to win?
Correct. I'm going to say something slightly spicier. I think the SaaS industry or software industry has sort of gotten used to like, oh, these like software companies should have 80+% or 90% gross margins. And if you sort of take a step back and like, what does like 80% gross margin mean in practice? It's like basically means a 5x markup on the cost to serve to a customer. And in the past, it hasn't been that expensive to serve these customers with like good application tools, etc. Now that we have AI and more compute and personalized experiences, it is going to be more expensive to serve customers. And I think this is not going to just make it automatically more expensive for everyone to have these products.
Yeah.
I think structurally there's going to be a margin reduction, particularly see it for SaaS companies that are now being disrupted. Prices will have to come into account when you look at, should I build something myself or should I buy something? If you're competing with the opportunity to build something that's 80% as good directly versus buying a off-the-shelf tool that might not even be perfect for you, you now have a new competitor, which is build it yourself with AI.
What's different about cash burning AI companies in 2026 versus the cash incinerating companies of 2021?
A lot of the value for businesses are in the terminal value. How much value will this deliver long term? And I think in 2021, I think we were perhaps a little relaxed on how much value these companies would generate in terminal value. I was at low interest rate environment at the time, and we assign a lot of value in that terminal growth rate driver for these businesses.
Bucket was chunky.
Very, very chunky. I think as you see it today, you don't have to be particularly creative to imagine a world where AI is creating an enormous amount of value for individuals, for businesses, for the world, I think medicine. So I think there is likely to be meaningfully more substance in that terminal value growth rate driver today than it was in 2021.
Every public company out there today in the investor presentation has this chart, right? It's a P&L and it shows this is what our margin profile looks like today as a percentage of revenue. This is what we think it is in 3 years. This is what we think long term. Do you think in the future, the gross margin will be lower, but the profitability will be able to be the same or higher? Like, how does that
Possibly,
look?
yeah. So, if you can be more efficient with your OpEx by perhaps having more efficient employees, you should be able to drive more revenue.
Yeah.
Perhaps with slightly lower gross margin, but still very healthy EBITDA margins, right? So in the past, what was gross margin really why did people care so much? It was effectively a metric or barometer, if you wish, for how much value is there in this business. Like, what is the premium someone is willing to pay for this service? And I think some of that value is going to shift as a result of AI, where the value of the service that is being offered will actually go to the LLMs and shift over in that direction. and you're going to recapture some of that value and increase productivity.
The greatest lie the devil ever told was the assumption that if you have this gross margin, you could technically turn off the G&A and the sales and the R&D, and they would all stick around, and in perpetuity, we could serve just this customer base at that. But we all know the customers care about the roadmap. They care about what you're building down the line.
Take a step back and like very basic sort of finance one, what is like the thing that ultimately drives value is like long-term cash flows.
Yeah.
Right? In the very, very long term. It shouldn't theoretically matter how you got, let's pick a cool number, like $10 billion in free cash flow in a year. If that is coming from a business that does $1 trillion in revenue at 50% gross margins with some OpEx, and you're generating $10 billion of free cash flow, that's going to have some value. And now you've maximized for like insane amount of revenue. Perhaps it's somewhat disappointing gross margins. We have a more efficient OpEx structure. And in another world, we're like, oh no, we were like really focused on high gross margins. And now you have a much smaller business by scale. More people are sort of making the trade-off that I would rather build something myself versus using your service. Like you should be optimizing for like gross margin dollars. And then you should be optimizing for EBITDA or free cash flow dollars.
Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. Right Rev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. RightRev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com.